One of the worst parts about being a real estate agent is I have to track the real estate market. And if you've ever done that for a couple months, years, or since it's ever started, you'd understand it's one of the most volatile markets that you could ever track. But in today's video, I'm breaking down the top 5 things that you need to know to at least comprehend relatively what's happening in the market. But first, I am a realtor here in Orange County. So if you are looking to buy, rent, or sell, make sure you reach out to me. All my information will be in the description below, but I will also put my number right here. That way you can easily give me a quick text or call if you have any other questions. But now we'll get back into the video. Point number 1 is we're going to be talking about the changes with student loans and mortgage qualifications. Roughly 6 million student loans are currently delinquent. And starting in October, the Treasury and Department of Education are expected to begin garnishing wages. Why does this matter for housing though? 35 to 40% of GNMA borrowers carry student loans. And HUD guidelines say that borrowers can't modify their loan if they're carrying delinquent student debt. Add in all the other costs associated with getting a loan and having all of your payments, you can understand how getting qualified as someone who has student loan debt is going to be very difficult. So the bottom line is lenders are having a difficult time qualifying buyers, and buyers are having a difficult time qualifying for loans. So it's just a really hard landscape, and they're doing a lot of things in the back end to hopefully change some of the rules and regulations in regard to student loan debt and qualifying for mortgage loans. Point number 2 is the pending sales snapshot. So there's a couple different factors when it comes to homes in circulation. You have active homes for sale, pending homes that are under contract but have not sold yet, and then you have sold homes that sold. So active shows the inventory, pending shows a little bit more of the demand, how many people are actually buying and circulating homes. And closed also is kind of similar to pending, how many people are actually purchasing these homes. So month over month since July, we've actually had a 0.4% decrease in the actual purchase volume in pendings. However, we're still up 0.7 year over year. So what does that mean? Right now, nationally, we're starting to see a slow tick down in pendings because of the anticipation of rate cuts and interest rates coming down. But year over year, we're still higher in demand because affordability has become a little bit easier for most buyers. However, it changes more regionally. And actually in the West here, month over month, we're up 3.7% in pending sales. So it really depends on where you're at. However, we are starting to see, in most case scenarios, a little bit of a dampening in the pending sales and demand just because there's so much possible good on the horizon, which we'll get into in a little bit. Point number 3, we'll talk specifically about Orange County. Now, currently, we finally have an inventory of over 5,000 homes on the market, which is great. Now, I just want to make sure that we stop something here. People are worried about a crash. Before the crash in 2007, we had roughly 15 to 17,000 homes on the market in Orange County. Now we're at 5,000. So we're still at a third of that. So a crash coming to Orange County anytime soon is highly unlikely. Also, on top of that, we have 61% of homes selling below list price. So what that means is over half the time, you're able to get a good amount of savings. So it's more of a relatively normal market for what real estate looks like. And buyer demand actually ticked up 3% here in Orange County month over month because we have interest rates now hovering between 6.5 and 6.6%, where if you look at the beginning of the year, we were closer to 6.8, 6.9. So the affordability has really grown for a lot of buyers. However, the interesting thing to note is the expected time on market is 91 days. Now, if you were looking at the market in the 2020, 21, 22 seasons, you would see that homes were having 10 offers overnight and selling in less than 10 days. That was when we had this crazy frenzy of a market, but now it's getting a little bit more stable to what we normally see. So if a home goes on the market, within 91 days, on average, it should be expected to be going under contract. And that's why we're having so many people be able to negotiate below the list price because homes are just sitting longer. Point number 4 is mortgage products and lending shifts. So because interest rates are still relatively high, especially in comparison to the last 5 years or so when we had the 2.9% interest rates, lenders aren't getting a lot of refinance loans. However, what they are getting a lot of is home equity line of credit loans. So what that is you buy a home for $100,000. Now it's worth $400,000. You have $300,000 in equity. You can actually tap into that before you ever sell it through a home equity line of credit. So that's what's happening for a lot of homeowners right now because they really can't and no need to refi. The other factor too is, let's say you're in a home, you have all of this equity, but rates are so high that you can't afford the next bigger home without selling your home. So you have to sell contingent. Selling contingent can be difficult on the back end, and it can make your home sit longer, and it's just a little bit more of a stressful process. So what other lenders and banks and kind of associations are starting to do is buy before you sell programs. So what that is they'll be able to give you cash upfront. So let's say $1 million, and they'll charge a 4% fee on that, where you can go buy a home for $1 million cash, non-contingent, and then you have 90 or 120 days or however long that specific program is to sell your home, and then they'll start charging more and more interest as it stays on the market. But again, expected days on market's around 91. So it's more than likely that you can get it done before you ever get charged more than that 4%. Point number 5 is the economic outlook and kind of the market in general. So what we have to understand is there's a couple things right now that are really pungent in the changes in real estate right now. There's 3 things mainly. Number 1 is the Fed. Number 2 is the jobs reports that have been coming out. And number 3 is Mr. Donald Trump. So first we'll talk about the Fed. The Fed, Jerome Powell just said that we're going to most likely see 3 rate cuts in September, October, and December. Once he said that, we saw interest rates go down in expectancy of that. On top of that, when we have bad jobs reports, meaning that there's less jobs being created than we thought, interest rates will go down. That's been happening a bunch. They keep saying they're going to cut rates. We keep having bad jobs reports, and that's why we've had this swing from roughly 6.8 down to 6.5, the lowest we've seen interest rates in the past 11 months or so. Now on to Trump. You already know, but it's just a very volatile market. He's trying to do a lot of different things. Some people love it, some people hate it. He also is trying to fire one of the Fed staff right now, and the possibilities of going to war. So that whole thing we're going to put to the side because no one can really control that. So we're going to focus a little bit more on the Fed rate cuts and the jobs reports. So in regards to the Fed rate cuts, so what happens if in September, October, and December they cut the rates? If nothing else happens, because this is not the only thing that affects interest rates. But let's say it was for a second. Let's understand what would happen. If the Fed cuts rates exactly how they said they were going to, interest rates really won't change. If anything, they might uptick a little bit. In the same way, if they cut rates less than they said they were going to, interest rates will most likely remain the same, if not more than likely, go up a little bit. However, if the world is even more volatile and the economy is more volatile and they end up cutting rates even more than the 25 basis points that they were talking about, then we could definitely see interest rates come down. A lot of people are expecting low 6s by the end of the year, 6.25. Some people say below 6. I don't think it'll be that low. And you also never actually know what's going to happen. So just to preface that, this is all just kind of hunches on economic data, but that's kind of where we stand right now. So the basic idea, to sum it up, is we have the lowest interest rates that we've had in the past 11 months. We also have the highest inventory that we've had in 5 years, and a lot of buyers are getting great savings right now off of list pricing. They're able to negotiate great terms where they can have closing costs covered, or they can have their interest rates buy down with the seller's money. So it's a great time to buy if you can afford it. The difficult part is just most people can't afford right now. But that's really the whole video. Make sure you do subscribe because I release videos just like this one every single Friday, so you want to make sure that you don't miss out. But as always, thank you so much for tuning in to this week's video. Can't wait to see you in the next one. We'll talk soon.